Welcome to The Explainer. Today we are diving into a big one, life insurance. I know, it can feel pretty overwhelming, but what if I told you that understanding the whole thing is actually as simple as deciding whether to rent or to buy a house? Seriously, by the end of this short explainer, you'll see exactly what I mean and you'll be able to spot which of the 5 main types of insurance could be the right fit for you. So this is it. This is the single most important idea to get your head around when it comes to life insurance. Just think of it like a home. You can either rent your protection for a specific amount of time, or you can buy it and own it as a lifelong asset. If you can remember this one concept, everything else is going to click into place, I promise. So that leads us to the very first decision you have to make. And it really boils down to that one choice. Are you looking for temporary protection that's going to cover you for, say, a set number of years? Or are you looking for a permanent asset that's designed to last your entire life? And this breaks it down perfectly. On the left, we've got term life. That's our renting option. You get temporary coverage, and the payments are way lower. But just like renting an apartment, you don't build up any equity. On the right, you have permanent life. That's the buying option. Your payments are going to be higher, no doubt, but you're building up something called cash value. You can literally think of that as the equity in your policy. It's a real asset that you own. Okay, let's start with the most straightforward, most common option out there, term life. This is your renting solution for life insurance. You know, it works exactly like the name says it does. You pick a term, maybe 10, 20, or 30 years, and you're covered for that whole period. If something happens to you within that term, your family gets the payout. Simple as that. But if the term ends, the coverage just expires, just like when a lease ends on an apartment. So who's this really for? Well, picture someone in their 30s. They just bought their first house, they've got young kids running around. Their main goal is just making sure the mortgage gets paid and the family is taken care of until the kids are grown up. Term life is absolutely perfect for this because it provides a huge amount of protection for a really, really low cost during those critical years. So what's the catch? What's the trade-off? Well, the upside is huge. It's the absolute most affordable way to get a big death benefit. It's simple, it's effective. The downside? It's temporary. Once that term is up, all your payments are gone, and if you want new coverage, it's going to be a lot more expensive because, well, you're older. Okay, now let's switch gears. We're moving from renting to buying. Permanent insurance is designed to do exactly what it sounds like, last for your entire life. It never expires as long as you keep paying the premiums. And this right here is the game changer for permanent policies. A piece of your higher premium payment actually goes into a special cash value account inside the policy. This account grows over time, and this is really important, it grows tax deferred. That means you don't pay taxes on the growth each year. It becomes a real financial asset that you can actually tap into later in life. Now, buying isn't just one single option. It's kind of like how you can buy a condo or a townhouse or a big single-family home. There are different types of permanent policies. So let's walk through the 4 main ones. First up, we have whole life. This is the classic, the original gangster of permanent insurance. With whole life, everything is guaranteed. Your premium will never, ever change. Your death benefit is locked in, and your cash value growth is guaranteed by the insurance company. It's basically the bedrock of predictability. This policy is really for who we'd call the predictable planner. This is someone who values guarantees above everything else. They want to use it for big, long-term goals, like leaving a tax-free inheritance, or maybe making sure there's enough cash to pay off estate taxes without the family having to sell off other assets. It's all about creating total certainty for the future. Next, we have universal life, or UL, and its number one defining feature is flexibility. See, unlike the rigid, fixed nature of whole life, a UL policy lets you adjust how much you pay in premiums year to year. You can even change your death benefit amount as your life changes. This is built for the flexible high earner. Think of, say, a business owner whose income might go up and down. In a great year, they can dump more money into the policy to build that cash value faster. In a leaner year, they can pay the bare minimum just to keep the coverage going. It's all about giving them control. All right, now let's look at Index Universal Life, or IUL. This takes all that flexibility of a UL policy and then adds a really interesting twist to how the cash value grows. Instead of earning a simple interest rate, its growth is tied to the performance of a stock market index, something like the S&P 500. This one's designed for the market-savvy investor, This person is looking for the potential to get better returns linked to the stock market. But, and this is key, without the risk of actually losing their principal. See, these policies have a floor, usually at 0%, which means if the market tanks, their cash value is protected. It's a strategy for aiming for higher growth while still having a safety net. And finally, we have Guaranteed Universal Life, or GUL. Now, this one is a fascinating hybrid. It's a permanent policy, so it's designed to last your whole life, but it's been stripped down to focus on just one thing, providing a guaranteed death benefit for the lowest possible cost. It has very little or sometimes even no cash value. So who's this for? This is for the legacy-focused planner. They might be a bit older and aren't really interested in another savings vehicle. They just want to know with 100% certainty that there's going to be money there to cover final expenses or to leave a specific inheritance. It's the cheapest way to buy a permanent death benefit, plain and simple. Okay, let's pull all of this together. This table really gives us the big picture at a glance. You've got term, your rental option, right at the top. Lowest cost, but it expires. Then you have the 4 buying options, and each one has its own distinct flavor. Whole life is all about guarantees. UL and IUL give you flexibility and growth potential. And GUL offers that straightforward, low-cost, permanent benefit. So after all that, how in the world do you actually choose? Well, the answer isn't about which policy is the best one. It's about which policy is best for you. It all comes down to your personal goals. Here is a super simple 3-step framework to guide your thinking. First, time frame. Just ask yourself, am I renting or am I buying? Second, budget. What are you after? The absolute lowest premium you can find? Or are you willing to invest a little more for those added benefits, like cash value? And third, what is your ultimate goal? Is this purely a what-if safety net, or is it also a tool for building and passing on wealth? Seriously, answering these 3 questions will point you directly to the policy that just fits your life. And ultimately, that's the key takeaway here. Choosing the right life insurance isn't about finding the best product out there. It's about finding the one that perfectly fits the current chapter of your life story. So the real question is, are you looking to rent for now? Or are you ready to start building for a lifetime? Thanks for joining us on The Explainer.